The Reserve Bank has put up the cash rate for the first time in 11 years. So what does this actually mean for the economy, for first home buyers? Are we going to get back to those 90s interest rates in the teens? Does it mean there's going to be massive house price corrections across Australia? And if you've got a pre-approval, you're looking at buying a home this year, does this mean the end to all your dreams? In this video, we're going to break all of this down. We're going to go through what has happened with the latest cash rate increase, what it means if you're looking at buying, if you own a home, if you're renting even, and if you're looking at buying a home, what impact this is going to have on your borrowing capacity and what the actual forecasted interest rates look like over the next 2 years so you can get a bit of certainty in the current market. So let's start it off with the announcement yesterday where the Reserve Bank, for the first time in 11 years, has put up the cash rate from 0.1%, which remember is at an emergency low. It was only put that low to get everyone through COVID, and obviously it's done a great job because the economy has actually performed better than the Reserve Bank expected. So they've put up the cash rate to 0.35%, so it's an extra 0.25%. All the big banks have said they've passed on, they will be passing on the full interest rate rise to home buyers sort of later in this month. It's ranging in the next couple of weeks. I'd imagine a couple of other little banks will probably follow the same in the next few days. I guess the good thing with this initial announcement with the banks is it means that they're not adding on any extra to the interest rate rise, which we'll come back to in a bit because I'll show you what impact that's going to have, because in a lot of previous cases, the banks haven't just passed on what the Reserve Bank has increased the rates by. They've actually increased and bolted a little bit extra on, which sucks. But anyway, the Reserve Bank has done this in response to the economy actually doing way better than expected. They're expecting unemployment to decline to around 3.5% by early 2023. The lowest unemployment in almost 50 years. The economy is looking positive. So pretty much the Reserve Bank's trying to, I guess, slow down some of the growth and make it so, inflation, fuel price, cost of living doesn't spiral out of control, and they do this by putting the cash rate up. I guess it does suck if you own a home because it means that mortgage repayments are going to go up. And even if you're renting, it potentially means that your landlord's mortgage is going to get more expensive and they'll unfortunately pass that on to you. But I don't like some of these articles. It was this AFR one here. There's a lot of fear and negativity in the media at the moment, and they're saying, this article, they're saying the outlook's quite dire, inquiries are down. This Sydney-based buyer, Peter Nay's mortgage repayments are going to rise by $3,000 a month if interest rates rise to 6 or 7%. So are we going to go back to these times like they were in the 90s where interest rates were 17% and fixed rates from 15%? Are we in doom and gloom territory? And this is the part of the video I want to sort of break down and look at this, because I think this is the thing that I've had a lot of freaked out people call me in the last day or two and say oh my God, my mortgage repayments are high. What if they get higher? How am I going to be able to afford interest rates if they hit 6 or 7%? I think the reality, there's not one bank that's saying in the short term, the next 2 to 3 years, interest rates are going to go from 3% to 6% to double. It's just not going to happen. And let's break this down and look at NAB's actual forecast. So they're saying where the interest rates are. They obviously didn't get this right for today, but to prove the point, they're saying in the next 2 years, the cash rate could get to 2%. So it could be 2% higher. So I've sort of broken this down in a spreadsheet here. And for the too long, you don't want to read based on, say, a current variable rate of, say before the rate rise, 2.75%, your repayments per month on a $500,000 loan are $2,041 per month. If and when the interest rates jump up, say 2%, I'm adding on about 10% there for the banks, your repayments would go up to $2,500. So they're going to be $500 extra a month. It's pretty far from the few $1,000s that they were saying in the article when they get to 6 or 7%. So I think the too long didn't read sort of part of this video is if you're really concerned about interest rates, add 2% on there. That's what the banks are forecasting. If they were freaking out and getting on this sort of sensationalist media and saying 6 or 7%, it's just not going to happen in the short term. The economy would just implode, and then the RBA would stop putting up interest rates and actually look to cut to put support and try and push the economy forward. So it's just not going to happen. Potentially factor in a 2% buffer. And as you can see from this sort of breakdown that I've done, it's sort of comparing fixed and variable rates, but the too long didn't read version is if you can afford to make 2,500 in repayments today, then do it. It's definitely going to be useful and help you get through the next couple of years and build up. Also covered in another video a little bit earlier this week. Potentially, if you're feeling you want to try and make extra payments to your mortgage, look at potentially renting out rooms and that sort of stuff. Or if you're really, really worried about the interest rates going up and not being able to afford it, and potentially look at fixed rates, and it'll give you some certainty of repayments there. I think it's really easy in these situations to get caught in the headlines, all the fear and doom and gloom, but realistically, the RBA has no precedent of increasing interest rates when the property market's been dropping. So I think those forecasts of 6 or 7% in the short term are definitely overblown. Remember back in COVID, the end of negative gearing was going to be the end of property markets. We knew it, 40% drops, and none of that came to pass. So again, you've got to run your own race. Definitely do the figures, potentially factor in interest rates, coming from where they are in the 2s, maybe to the high 4s, maybe 5%, and work around that. But I think definitely 6 or 7%, like that AFR review article was showing, is unlikely. But to my earlier point, what happens if you're pre-approved? That was kind of the second question I've had a lot this week. How's that going to affect your borrowing capacity? The long and short of it is it can. So the banks base your pre-approval on a reference rate. So at the moment, the sort of floor reference rate might be sort of 5.5%. So in this case, if you're on, say, this one was based on, say, $70,000 a year, your maximum borrowing capacity might be around $530,000. But with the cash rate rising up, you could go from 530 to 500, call it 15, 16,000, and you are going to lose some of your borrowing capacity as rates go up and up and up. It's the same case, if rates end up going up by 2%, you've gone from 530 to 430, so you're losing $100,000 in borrowing capacity. So the ways to kind of mitigate this are potentially looking at getting a pre-approval now. The banks would, with a number of banks, they'll honor the assessment rate at the time of pre-approval application. And they'll still honor that as long as you don't go above and need your application reassessed. So if you're worried about kind of missing out and having your pre-approval wings kind of clipped in the next couple of months, if you're looking at buying in the next sort of 3 or 6 months, you definitely want to hit up your broker and make sure you're working with a bank that will honor the current assessment rate, as at today, as at when you're getting the pre-approval, rather than as at in sort of 3 or 4 months' time when the rates look likely to move again. I think that's a big thing. I think the details about a property market crash is really overblown. I've referred to this article a couple of times. Remember, property market works in cycles, and over the last 50 years, interest rates have been way higher than they have been now, and they're likely to get higher in the short to medium term. Between 2002 and 2008, interest rates increased from 6.3 to 9.5%, and the median house price in most capital cities more than doubled in 6 of the 8 capital cities. Even in the 90s, that period we saw before, there was still dwelling value price increases. So, it's just kind of media to get people to tune in, saying that interest rates are going to cause this huge collapse. If the rates are just having to go up, you have to factor that in. And like you could see from that sort of, pretty rough example, based on NAB's forecasted interest rates, if we do, and when we do get to say 4.5% in the next 2 years as kind of the normal mortgage rate on a $500,000 mortgage, the repayments will go up about $500 compared to where they're at today. So potentially start factoring that in and building in that buffer now, just so you're not going to get sort of caught out and going to get any shock. Or look at things you can cut back now. Are there any sort of subscriptions or Netflix? Can you do any side hustles, that sort of thing to get on top? And if you're really stressed about it, chat to your broker, look to refinance, potentially get your rate down. You can do a bunch of other stuff like that that can help sort of make those repayments more manageable. But definitely while the rates are low now, you want to try and get on top of things. And like I said, it's looking pretty unlikely that a bunch of homeowners are going to go into default because the rates are still historically low. And as we went through another video earlier in the week, savings are at all-time highs, Reserve Bank and all the banks feel like the economy is looking really, really good. There's really good prospects ahead for Australia and the economy. So try not to get caught up in the headlines too much. Look at your own situation, look at what you can control. If you've got enough deposit today, we'd love to help you out. At Hunter Gallery, we're mortgage brokers rather, that help home buyers across Australia. There's no cost for our services. So hit us up. Let me know what you think about the latest RBA updates and some of the banks, what the interest rate increase is going to cause. Are they going to cause you any stress? Are you worrying about it? Let us know below. And if you need any help with your home loan or mortgages, hit us up at huntsgalloway.com.au. Okay, till next time, see ya.